Welcome to the Microlearning Institute. In this tutorial we look at a question called Denmark from the AIA Paper 13 question paper from May 2013. And in this question we prepare the group statement of financial position at the 30th of April 2013 for the Denmark group. Now Denmark comprises three entities in its group. It's Denmark, Kents and Zenu. So firstly, let's look at Note 1 and the details around Kents. Firstly, we want to look at what is the fair value of the net assets of Kents at acquisition by Denmark. Now we're told in the question that Kents has ordinary share capital of 783 million, retained earnings at acquisition were 389 million, other components of equity at acquisition were 34 million, and we're also told that the fair value of the net assets of Kents at acquisition was $1,216 million. So consequently, as a balancing figure, we can conclude that we need, as the group accountants, to prepare a fair value adjustment. And in the question, we're told that this fair value adjustment of $10 million relates to non-depreciable land. Now, at this point, it's useful to make a note of what are the fair value of reserves at acquisition of Kents, because of course later when we're preparing the consolidated reserves figure, we'll want to know what is the growth in reserves since acquisition been, so that we can allocate the group share of the post-acquisition reserves. So the fair value of reserves again is made up of the carrying amount of reserves in Kents at 389 million, plus of course that adjustment for non-depreciable land, which adds to the group assets of Kents at acquisition, and of course also then as a balancing figure adds to the group reserve. So we can see the fair value of reserves of Kents at acquisition by Denmark at 399 million. So now that we know the fair value of the net assets at acquisition, we can look to calculate the goodwill at acquisition of Kents. Again, the policy is to measure goodwill in the non-controlling interest at fair value. So firstly, let's look at the cost. And again, in the question we're told that the group share cost us 780 million. We're also told in the question that the fair value of the non-controlling interest at acquisition was 514 million, giving us a total cost at acquisition of $1.294 million. Now we need to compare these figures now with the share of the fair value of the net assets acquired by both the group and the non-controlling interest. So the group acquired 67% of that fair value net assets of $1,216 million, resulting in a goodwill at acquisition within the group of $34.7 million negative. However, the non-controlling interest, we match the 33% holding that the non-controlling interest have of fair value net assets with the fair value of the non-controlling interest at acquisition, and we discovered that the goodwill recognized in the non-controlling interest is 112.7. So overall, goodwill of $78 million is recognized at acquisition of Kents. Now, we're then told that the company acquires an additional 11%. And again, it's interesting to see how IFRS 3 advises us to account for this. So, prior to the acquisition of the 11% of Kents, Denmark is already in control of Kents, because of course we already have 67% of a holding of Kents. Therefore, the transaction of purchasing the 11% additionally does not cross the control threshold of 50%, and consequently it's accounted for as a movement in equity. Again, the IFRS 3 regards this as a share transaction between owners and a movement in equity. Now, to calculate the movement in equity, we compare what Denmark paid for the additional 11% with the carrying amount of the 11% of the net assets of Kents on the books of Denmark. So let's firstly look at what is the carrying amount of the 11%. So on the books of Kents, the ordinary share capital is 783. The reserves at the date we purchased the additional 11% was 575. Other components of equity is 48, and of course we still have that fair value adjustment there because it's non-depreciable at $10 million. So the total fair value net assets of Kent's at the date that the additional 11% was purchased was $16 million. Now 11% of that of course is what we acquired, and that was $155.76 million in value from the non-controlling interest. However, of course, we had recognized goodwill in the non-controlling interest. Now previously, of course, you'll remember that the non-controlling interest in total represented 33% of the fair value of the net assets. Now that Denmark is acquiring 11%, we're effectively acquiring another 1/3 of that 33% of the goodwill. So again, 1/3 of the goodwill that was recognized at acquisition in non-controlling interest of 112.7 is 37.56. So consequently, the carrying amount of the 11% piece of Kent's that was additionally acquired by Denmark at the date of acquisition was $193.32 million. So we must now compare that carrying amount with how much we actually paid for it. So again, the carrying amount, as we've said, is $193.32 million on the date we acquired the additional 11%. What we paid was $184 million. So consequently, this is regarded as a gain to equity. So because we paid out of equity $184 million and we received into our equity a value of $193.32 million. And later we'll see this movement going to the consolidated equity reserve. Now let's consider the impairment that occurs on the 30th of April 2013. So let's look at the carrying amount of Kent's at that date, the 30th of April. So again, we see from the statement of financial position that we have ordinary share capital of 783, we have reserves of 575, other components of equity of 48, and a fair value adjustment of 10. Now additionally, we have a total goodwill of 78. So this carrying amount of the cash generating unit that is Kent's at the date of the 30th of April 2013 is $1494 million. Now of course we have to compare that carrying amount with the recoverable amount, and we're told that the recoverable amount of Kent's on that date is $1430 million. So consequently we've got to recognize an impairment of $64 million. And we take the group share of that impairment. Now the group share now, remember, is the original 76% plus of course the additional 11% that we now own. So we have now a total as a group share of 78%, giving us $50 million. The non-controlling interest of course now own their share, which is 22% of the assets and this equates to $14 million. Now let's have a look now at the acquisition of Zenu. Okay, now again, what are the fair value of the net assets of Zenu at acquisition? Again, it's made up of ordinary share capital of 507. We're told the retained earnings of Zenu at acquisition is 117. Other components of equity of 55, and net fair value net assets of $679 million. Now, the goodwill at acquisition, firstly, we must look at the fair value of the consideration. And in the question, the examiner has told us how Denmark have derived their fair value. But there are some adjustments that we may need to make to this. So again, we're told that Denmark paid cash of 643, and of course this is correctly included in the fair value of the consideration of Zenu. Acquisition costs of 12 are included in the 705. But of course we know from IFRS 3 that any admin expenses in relating to the acquisition are expensed to the P&L. So we'll remove that $12 million from the fair value of consideration. Now, we also had some blocks of land transferred. Now, firstly, some land was transferred to Zenu of $24 million. Now, this $24 million has been used in the derivation of the fair value consideration used by Denmark. However, of course, Zenu are now within the control of the group, so this transfer of land from Denmark to Zenu this land now remains within the control of the group, so consequently is not included as part of the fair value of the consideration. We also have land that's transferred to the former shareholders of Zenu. Now the carrying amount of that land is 26. However, of course, we know from IFRS 3 that consideration is recognized at fair value. So we must consider what is the fair value of that land. And in the question, we're told that the fair value of the land that was transferred to the former shareholders of Zenu is $35 million. So it's this $35 million we will use to derive the fair value of the consideration. Now, there's also a contingent element. So again, this hasn't been included in the derivation of the $705 million in the question. However, we know that contingent consideration is recognized at acquisition at its fair value. And in the question, we're told that the fair value of that contingent consideration is $40 million. So this $40 million is also now part of the consideration. Now, so the original $705 million that was recognized is now adjusted, so the correct fair value consideration is now $718 million. So now that we know the correct fair value consideration, we can now calculate the goodwill at acquisition of Zenu. And again, very simply, we paid $718 million. We acquired fair value net assets of $679, giving us goodwill on the acquisition of Zenu of $39 million. Next, we can look at Note 3. And Note 3 talks about property, plant and equipment. And it says that included in Denmark's property, plant and equipment is a research plant with a carrying value of 50 million. So Denmark is required by legislation to dismantle the plant at the end of its useful life and has therefore built up a dismantling provision of 10 million in the financial statements. On the 30th of April 2013, another pharmaceutical company offered to buy the plant for 47. The offer includes taking over responsibility for the dismantling of the plant. Denmark has estimated that the present value of the estimated cash flows from the plant continued in use by the group is 55 million. So now there's a question about impairment here. So again, the carrying amount of the plant per the question, we're told, is $50 million. We need to compare that with the recoverable amount. Now the value in use is the $55 million less, of course, the cost to sell, which is the $10 million of the dismantling charge, which of course is 45. And the fair value less cost to sell were given in the question at $47 million, okay, which is the value that the other company offered to pay for the plant. So the recoverable amount is now the higher of the value in use and the fair value less cost to sell, which of course is, in our case, is $47 million. So consequently, we've got to recognize an impairment in the carrying amount of this plant of $3 million. Next, let's move to Note 4. And in Note 4, we're told that included in the financial assets of Denmark is a portfolio of 5% loans. The effective rate of interest is 10%, and Denmark has adopted IFRS 9 financial instruments, and the portfolio is included at its amortized carrying value of 118 million. However, on the 30th of April 2013, Denmark granted a concession to the borrowers which requires an immediate payment of 14 million, followed by two payments of 50 million at the end of each of the next 2 years. The effective interest rate under the concession is 9.3%, and the current market interest rate is 10.7%. So let's look at the carrying amount of the loans, and again, per the question, we're told that the carrying amount of the loans is $118 million. The recoverable amount, in this case, is the present value of the future cash flows. And we've agreed now, as part of this concession, to accept an immediate $14 million and 50 million at the end of year 1, and another 50 million 2 years later. And again, when we discount these at 10% to their present value, it gives us a recoverable amount of the loans of $101 million. So if the carrying amount is 118 and the recoverable amount is 101, again we must recognize an impairment in relation to the carrying amount of the loans in the books of Denmark. Next, let's look at Note 5. And in Note 5, we're told that in an attempt to boost sales of one of its new products on the 1st of May 2012, Denmark appointed 100 employees on fixed 3-year contracts. The starting salary for each employee was $200,000 per annum. It is estimated that salaries will rise by 8% per annum. Denmark agreed to pay each employee a retirement benefit of 10% of the final salary per annum for each of the contractual period. Denmark's entity-specific credit risk is 7%. The yield on AAA or AA corporate bonds of a term and currency consistent with the obligation is 5%. No entries have been made in the financial statements. So let's have a look at this. So there's a final salary liability of 100 employees multiplied by 200k and again, of course, increasing at 8% per annum. So again, the final salary liability is just over $23 million. Year one's current service cost is again 10%, we're told, of the $23 million, again giving us $2.3 million. So the present value discounted at 5%, which is the yield on corporate bonds, equates to just over $2.1 million. And again, this is split between, this is debited and credited as a non-current liability and as a P&L expense in the period. Now that we've dealt with all of the additional information and all of the adjustments, we can now begin to prepare Denmark's group reserves at the 30th of April 2013. Now, consolidation of group reserves is a two-step process. Firstly, we update the individual entity reserves to reflect any group transactions and any transactions not yet accounted for. And secondly, we consolidate the group share of each entity post-acquisition reserves. So let's firstly update the group reserves of each entity. So we can see per accounts, per the statement of financial position for each individual entity, we can see the individual reserves of Denmark, Kent and Zenu. Now, we need to make some adjustments. So Note 1 told us that there was a fair value adjustment relating to non-depreciable land applicable to the assets of Kent's, and of course it's non-depreciable, so at the 30th of April 2013 that adjustment still needs to be made in the group reserves of Kent's. We're also told from Note 3 of an impairment of $3 million in relation to property, plant and equipment of Denmark. We're also told about the financial asset impairment in Note 4, and we've already calculated that the financial asset in the books of Denmark should be impaired by $17 million. And again, we're also told in Note 5 about the current service cost of the employee liability of $2.11 million. Now, the intercompany land transfer, again, as we said, this did not move outside the group. So again, the adjustment that we had made needs to be removed of 26 million. And again, the acquisition costs in Note 1 of 12 million, these are expensed to the reserves of Zenu. So the updated reserves, updated to reflect things that hadn't been accounted for and updated to reflect group perspective of Denmark, Kent's and Zenu are as shown on the slide. Now we have to update them. We have to now consider the group share post-acquisition in Kent's and Zenu. So let's look at the second stage now, where we consolidate these reserves. So all of the reserves of Denmark are consolidated, all of the updated figure of $1363.9 million. And we add the group share post-acquisition in Kent's, and of course the group share is 67%. The updated reserves that we've just calculated is 585. And again, from the acquisition of Kent's, we remember that the fair value of reserves was originally calculated at 399. So this group share post-acquisition adds $124.6 million to the group reserves with respect to Kent's. Similarly for Zenu, we consolidate 100%, which is the group share of the updated reserves less the reserves at acquisition. And again, this 100% is $65 million. So the consolidated reserves are $1553.5 million. We remember that the group Goodwill has also been impaired, and that impairment is $50 million, and this impairment from the recoverable amount exercise that we did earlier. So therefore, the consolidated reserves to the consolidated statement of financial position of the Denmark Group at the 30th of April 2013 are $1503.5 million. We can now move on and do a similar exercise for other components of equity at the 30th of April. Again, similar process to previously. So firstly, we update other components of equity. Per accounts, we can read 78, 48 and 59. Now you remember the movement in equity of 9.32, the gain in equity at acquisition of the additional 11% of 9.32, and here we see it going to the equity reserves of Denmark. So the updated reserves are as per the slide, and now we can consolidate. We consolidate all of Denmark's updated reserves plus the group share post-acquisition in Kent and Zenu, giving us a consolidated other components of equity of $100.32 million. Next, we can look at non-controlling interest, and again we recall that non-controlling interest are a liability of the group, and non-controlling interest is calculated as the non-controlling interest percentage of the fair value net assets in the subsidiary at the balance sheet date. So let's look and see, can we calculate the fair value of the net assets in Kent's initially at the 30th of April 2013. Remember, of course, that there is no non-controlling interest in Zenu because we, the Denmark Group, own 100% of it. So the fair value net assets in Kent's at the 30th of April 2013 is $1416 million. The non-controlling interest share is now reduced to 22% because, of course, remember, we've acquired that additional 11% during the period. So the non-controlling interest share equates to $311.52 million. But of course, remember that we also valued goodwill in the non-controlling interest at acquisition, and there's still some goodwill out there. So we recognize the total goodwill of $112.7 million, and of course 2/3 of that goodwill are still remaining out there. We, you will remember, took 1/3 of that goodwill when we purchased the additional 11% of the assets of Kent's. So the 2/3 that's remaining out there equates to $75.13 million. Now, of course, we also had goodwill impairment in the non-controlling interest of 14, and giving us a carrying amount of non-controlling interest of 372.65. So now we can compile the consolidated statement of financial position. Firstly, let's look at the total assets side of the balance sheet. And again, for property, plant and equipment, we've got the individual entities, plus of course the fair value adjustment, plus the 24 for the land as such that was transferred to Zenu, but of course which still remains within the control of the group. So consolidated property, plant and equipment is $2566 million. Goodwill, again, the initially recognized goodwill in Kent's and Zenu, less the 64 that was subsequently impaired in total, giving us a carrying amount of goodwill of $53 million. Financial assets, again remembering the $17 million impairment on financial assets, giving us a consolidated figure of $163 million. Current assets, again, in note 1 we're told that the $35 million in relation to the purchase of the sale price of $35 million in respect to the land transferred has been debited to trade receivables, and of course we now know that that should have been included in the fair value of the consideration. So again, that consolidates current assets at $2729, giving us a total assets figure on the consolidated statement of financial position of $5,508 million. On the other side of the balance sheet, with liabilities and owner's equity, we see the ordinary share capital, and of course, as normal, the ordinary share capital is that of the holding company Denmark only, which is 1456. We've already calculated a value for consolidated reserves at 1504. Similarly, we've already calculated other components of equity at 100. Non-controlling interest, we've already calculated at 373. Non-current liabilities needs to be adjusted for the current service cost, which hadn't been considered, giving us a consolidated value of non-current liabilities of 1109. Current liabilities, again, need to be adjusted for the contingent consideration. Okay, so the contingent consideration, again giving us a consolidated figure of 966, resulting in total assets, total liabilities and owner's equity of 5508. Thank you very much for watching this short tutorial from the Microlearning Institute.